Hello everyone. So let's start with the new topic. In case of bond valuation, how yield is derived, desired yield is derived, and this is mainly derived from our new topic, that is matrix pricing. Now what is matrix pricing? We have already done valuation of bond using the desired yield, whether it is a flat price or a full price on coupon date or between two consecutive coupon dates. Now question comes here is कि जो desired yield है, how investor is going to get that desired yield, how he is going to derive that yield. Problem bonds के केस में क्या है, compared to equities, equities are frequently traded on stock exchange because trade value बहुत छोटा होता है. Almost if a share is of 100 rupees, one person wants to buy one share, he can buy that share. So trade value is 100. Price discovery बहुत easy होती है equities के केस में. प्रॉब्लम है बॉन्ड में, जहां पर जनरली डील साइजेस बहुत बड़ी रहती है. सो नॉर्मली रिटेल इन्वेस्टर इतने फ्रीक्वेंटली ट्रेड नहीं करते, और जब रिटेल इन्वेस्टर फ्रीक्वेंटली ट्रेड नहीं करते और ओनली लार्ज सम में ही डील्स हो रही है, जहां फाइनेंशियल इंस्टीट्यूशन, म्यूचुअल फंड्स, इंश्योरेंस, बैंकर्स, प्राइमरी डीलर्स, ये लोग जहां डील कर रहे हैं, तो वहां पर ऑलमोस्ट, क्योंकि बॉन्ड का यूनिवर्स इक्विटी के यूनिवर्स से बड़ा है, तो कई बार ऐसा होता है कि बहुत सारे बॉन्ड्स और डिबेंचर्स डेली बेसिस पे ट्रेड ही नहीं हो रहे, बहुत इनफ्रीक्वेंटली ट्रेड हो रहे हैं, इलिक्विड एसेट्स, इलिक्विड सिक्योरिटीज की तरीके से रह जाते हैं. सो अब प्रॉब्लम यह है कि या तो इशुअर को नया बॉन्ड इशू करना है तो उसकी प्राइस डिस्कवरी की प्रॉब्लम है, इन्वेस्टर परचेज कैसे करेगा. सेकेंड, जो बॉन्ड्स ऑलरेडी मार्केट में है, इशूड है और इन्वेस्टर इंटरेस्टेड है, बट क्योंकि वो इनफ्रीक्वेंटली ट्रेड हो रहा है तो उसका प्राइस डिस्कवरी अगेन एक इशू है. तो यहां पर जनरली बॉन्ड्स के केस में इवन जो कोटेशन भी कोट हो रहे हैं वो जनरली मैट्रिक्स प्राइसिंग के थ्रू डिराइव हो रहे हैं. अब ये मैट्रिक्स प्राइसिंग क्या है, और हमारे लिए ये न्यूमेरिकल टॉपिक है, अच्छा क्वेश्चन बनता है इसमें. सो लेट्स स्टार्ट विद द मैट्रिक्स प्राइसिंग. जैसे एग्जांपल इज इन केस ऑफ इंडिया, क्रिसिल बॉन्ड मैट्रिक्स इज यूज फॉर वैल्यूएशन. अब क्रिसिल रेटिंग एजेंसी, और ये रेटिंग एजेंसी किस तरीके की मैट्रिक्स बना के देती है, दिस इज अ रेडीमेड मैट्रिक्स अवेलेबल फॉर मार्केट पार्टिसिपेंट्स. एंड यहां पर क्रिसिल क्या करेगी कि वो क्रिसिल का जो बॉन्ड मैट्रिक्स का प्रोसेस है, बॉन्ड मैट्रिक्स का जो प्रोसेस है, उसमें वो दो कंपोनेंट्स को यूज करती है. नंबर वन इज क्रिसिल रेटिंग विच गोज फ्रॉम ट्रिपल ए, डबल ए, ट्रिपल बी, डबल बी, बी एंड सी एंड डी, एंड दी ड्यूरेशन, मॉडिफाइड ड्यूरेशन. इन दो वेरिएबल को यूज करके वो पूरा एक मैट्रिक्स बनाती है जिसमें वो मार्केट पार्टिसिपेंट से पोल करके वो क्रिसिल हमारे लिए यील्ड, रिक्वायर्ड यील्ड कैलकुलेट करके देती है, जिसके बेस पे और जो भी मार्केट पार्टिसिपेंट उस मैट्रिक्स को यूज करते हैं, सब्सक्राइब करते हैं, वहां पर वो उस मैट्रिक्स को यूज करके अपने एसेट, सिक्योरिटीज, बॉन्ड्स वगैरह की क्या करते हैं, वैल्यूएशन करते हैं. तो इंडिया में तो ये एक अवेलेबल सोर्स है, और भी बहुत लोग हैं जो आपको ये मैट्रिक्स बना के देते हैं. बट व्हाट इफ अगर हम ये मैट्रिक्स सब्सक्राइब नहीं कर रहे तो हम कैसे बनाएंगे? So let's go for that part. So matrix pricing is compared to equity securities. Let's see what text is saying. Compared to equity securities, bonds are less actively traded. Infrequent trading होती है because deal size बड़ी है तो बहुत कम बार ट्रेड होते हैं. It is common to estimate price by using price of comparable but more frequently traded. कुछ तो बॉन्ड ट्रेड हो ही रहे होंगे, हो सकता है उनका टेन्योर अलग होगा, हो सकता है उनका कूपन अलग होगा. तो वहां पर जहां कंपैरेबिलिटी स्टैब्लिश कर सकते हैं इन द फॉर्म ऑफ क्रेडिट क्वालिटी. क्रेडिट क्वालिटी अलग नहीं होना चाहिए कि हमारा बॉन्ड ट्रिपल ए रेटेड है एंड वी कैन नॉट यूज डबल बी और ट्रिपल बी फॉर आवर कैलकुलेशन ऑफ डिजायर्ड यील्ड. सो वहां क्रेडिट क्वालिटी, मेजर कंपोनेंट इज क्रेडिट क्वालिटी एंड सेकेंड इज टेन्योर. So using the prices of comparable but more frequently traded, because जहां more frequent trading है वहां पर price discovery easy है, because demand और supply है, तो these two forces will derive the appropriate price, and this estimation process is called as matrix pricing. तो लेट्स गो फॉर सम नंबर्स एंड देन हम इन स्टेप्स के बारे में भी डिस्कस करते हैं. सबसे पहला वो स्टेप यही बोलेगा कि आइडेंटिफाई द एक्टिवली ट्रेडेड कंपैरेबल. कंपैरेबल इज द मोस्ट इंपॉर्टेंट वर्ड. ट्रेडेड एंड कंपैरेबल बॉन्ड based on the similar time to maturity. Number one, similar time to maturity. Coupon may not be same but should be somewhat nearer, and the credit quality, generally credit quality established with the credit ratings, with the help of credit rating. So यहां पर जैसे क्रिसल बॉन्ड वैल्यूअर की मैंने बात की, क्रिसल बॉन्ड मैट्रिक्स किस तरीके का वर्किंग करता है, जो इंफॉर्मेशन है मेरे पास में उसके अकॉर्डिंग क्रिसल मॉडिफाइड ड्यूरेशन को यूज करता है रेदर देन टाइम टू मैच्योरिटी. वहां पर वो 0 to 1, 1 to 2, 2 to 3 एंड सो ऑन ड्यूरेशन को वो कॉलम हेडर बनाएगा. और यहां पर रेटिंग्स which starts with risk-free bonds to AAA and it goes down as the credit quality goes down, and BBB and so on. So if the risk-free rate of 0 to say 1 year tenure, or let's say because 0 to 1 year will be money market, so 1 to 2 year tenure it's trading at 6.5%. Of course AAA rated bond will trade somewhat higher because there will be a credit spread for the credit risk. So let's say it is at 6.8, and as the duration increases and if the yield curve is upward sloping, time and yield, it means your long term expectation of investor is higher than the short term expectation, then again it will move to right side with the increased spread over the yield, previous bond yield. So let's go for our working. किस तरीके से हमारे पास क्वेश्चन आएंगे, इलस्ट्रेशन ले लेते हैं हम यहां पर. इलस्ट्रेशन नंबर 1, let's say we want to value a bond, we want to value a 6% annual coupon paying bond, may be infrequently traded है या न्यू इशू है मार्केट में. coupon paying bond with face value of $1,000 maturing in 4 years time. So we have got coupon, we have face value, we have time, frequency, and the problem is we don't have price and we do not have what? Yield, and we need one item to derive second. Generally it is the yield which is derived first, and then from that yield we calculate fundamental price for taking our decision that whether we should purchase or not. Now how to derive the yield? So from market, let's say the name of this bond is bond X. From market data or from poll data, what we are going to get is the comparable same credit quality bonds yield which are actively traded in the market. So we got 4 bonds, bond A, B, C and D, and this is a 4% coupon paying bond, 5% coupon paying bond, 7% and let's say 8% coupon paying bond. Tenure as term to maturity is 3 years, 5 years and 5 years, and based on the trades, based on the actual trade data, their price, their face value, their coupon rate and their term to maturity, yield will be calculated, yield YTM will be calculated based on actual data, that is implied YTM, and we got that this 3-year bond is trading at a yield of, let's say 7%, and this is trading at 8%, and whereas the 5-year bonds are trading at 9% and 9.5%. Now how we are going to use this actual trade data to calculate the fundamental price of our newly issued or infrequently traded bond X. So we are going to create a matrix 3 years, 4 years and 5 years. We have bond A at a place of 4%, 5%, 6%, 7% and 8%. My bond A is placed here with a yield of 7%. Next, bond B is placed at 5 year, 5% and yield is, bond B is placed here with bond B is 5 year, 5% and yield is 9%. Next, bond C is a 7% bond with 5 year and the yield is, bond C is having a yield of 9.5%. 8% D bond is trading at 3 year, trading at 8%, it's the D bond. Now we want to value bond X, which is a 6% coupon paying bond. Bond X is a 6% coupon paying bond with a tenure of 4 years. So it is lying somewhere here and the yield is a question mark. Now what you have to do? Now what you have to do for valuation of bond X? Let's go for step 1. Step 1, calculate average yield. Average of implied yield. YTM of actively traded bond. Actively traded bonds. Calculate the implied yield, average. So for 3-year bond, YTM is equals to 7 plus 8 over 2 is equals to 7.5%. Generally, it is in case of CRISIL bond matrix, they are using volume weighted average yields. So different sources, different agencies are giving this matrix and they follow different procedure. Whatever procedure suits you, you can go for subscribing those matrices. So here we have simple average, let's say 5-year bonds, volume weighted average will be more better than the simple average, but in our course we have simple average, so let's go for simple average. So 5-year bond is having a 9 plus 9.5% yield divided by 2, it's 9.25%. So we got average yield of a 3-year bond trading in the market is 7.5% and the average YTM a bond of 5-year is giving is, which is trading in the market, is of 9.25%. Assuming that we do not have a frequent traded 4-year bond, otherwise we would have used that only. So now what we are going to do, we are going to do in linear interpolation. Linear interpolation, a very simple mathematics using the slope of a line or unitary method, you may say, or a simple calculation of if 2 mangoes are of 50 rupees, what is the price of 6 mango? It will be 50 divided by 2 into 6. So same that mathematics of unitary calculation we are going to use. Step number 2, linear interpolation. Now how to do linear interpolation? We know that this is a 3-year bond which is having a yield of 7.5. We have a 5-year bond which is having a yield of 9.25% and our bond is of 4 years. So what will be the let's go for, it's actually coming as a, again, simple average. So let me change the numbers, let me change the years. So let's say the years in these cases is 6 years. 6 years, 6 years. So this is going to be also 6 years and this is also going to be 6 years. So now we have a 3-year yield of 7.5 and a 6-year yield of 9.25. So what will be the linearly interpolated? We have 2 endpoints and now we want to find out the coordinates of a point in between the line segment. So it's again a linear equation. Now how to calculate it? Very easy. So now let's go for, so required yield or desired yield is equals to 7.5 plus, it will be something plus because 3-year is at 7.5 and 6-year is at 6 years bond is at 9.25, so somewhere it will be 7.5 plus something, because it should go up. Now what we have to do, we know that for 3 years time the total change in YTM is 9.25 minus 7.5 is equals to 1.75. So when bond increases from 3 year to 6 year, yield increases from 7.5 to 9.25, it means 1.75%. So for every 1 year, what is the change? For every 1 year, the change will be equals to 1.75 over 3 will give you 1.75 over 3 is equals to 0.5833%. Had it been 4.5, then we will multiply it with 1.5. If it is 5-year bond, we will multiply it with 2. So what I have done is, I have 9.25 minus 7.5 over 6 minus 3 multiplied by 4 minus 3. So this linear interpolation, this using the slope of line y2 minus y1 upon x2 minus x1, and using that for calculating the coordinates of a point between the line segments. So this is giving us a yield of 7.5 plus 0.5833 gives you 8.0833 plus 7.5, we have 8.08, and we will input that as IY. So we have got our desired yield. Now step number 3, now we can value our bond X. It is having a face value, future value of 1000. Next, tenure is 4 years, so N is 4. PMT is equals to how much? PMT is equals to 6%, so it is 60. And IY is equals to 8.0833. So let's calculate, compute PV. We got value is equals to 60,004 and PV 931.12 or 931.13 is the value of the bond arrived from desired yield, which is calculated from linearly interpolated implied yields of actively traded securities in the market. So let's see what is the text saying. Step 1, identify. First of all, identify. We have identified bond A, B, C and D, which are traded and comparable in terms of credit quality. Of course, the coupon rate and term to maturity should be nearer. We should not be taking a 2-year and a 30-year bond for calculating the yield of a 6-year or 4-year bond. Next, calculate white. So somewhere it should be near. Credit quality should be almost similar. So similar things should be there. Calculate YTM for each of the comparable bond and calculate average yield. Average can be simple and volume weighted average. In our course, we are using simple average yield for each maturity. And now YTM was already given for bond ABC in the question. Now linearly interpolate the YTM of comparable bond to estimate YTM of closest or newly illiquid bond maturity, which we have calculated as 8.08%, and then we have used that YTM for calculating the price of our bond X. So this type of question we can have in our exam. Second, a bit more complex, bond. So let's go for a second variety of question which we may get is where that second step, which is already given in this first illustration, that yield of all 4 A, B, C, D bond was given. They will ask you to calculate that also. So let's go for 2 bonds. Again, illustration number 2. Let's say we want to value bond P, bond Q, and bond Q is of tenure of 4 years with a coupon percentage of 10%, tenure face value of 1000. Face value does not matter because yield take care of that number. Proportionately, all numbers will increase or decrease. Now problem is, we have coupon, we have face value, we have time, but we do not have price and yield both. So we need yield. So two representative bonds. This is new issue. So there is no price discovery by demand and supply forces. These are actively traded comparable bond. Generally the credit quality and duration and coupon rate should be similar. So bond P and R are two bonds which have a tenure of 3 years and 6 years. Coupon rate is 9% and 9%. Both have face value is 1000 and 500, doesn't matter. Next, comparable credit quality, coupon is somewhere near, time is also nearer, face value we have, and the price running in the market, actual price is equals to, in this case bond is trading at 1050 and in this case bond is trading at 525. So now what we are going to do, we are going to calculate implied YTM of these two bonds. We have all the numbers, we have N, coupon is equals to 9%, means it will be PMT will be equals to 90. In this case it will be 45 because the face value is 500, FB 1000, 500 and 3, 6, PV negative 1050 inflow outflow format and negative 525, and we will calculate IY, compute IY. Let's see what is the yield for bond P. It is 90,000, 3 years, 1050 negative, and the yield is 7.0916%. One additional step, now we are calculating yield in this illustration. Earlier ABCD bond were having their yields available in the illustration. Next, second case, 45 is the PMT and 500 is the face value, 6 is the number of years, 525 negative is the present value, and the yield is 7.9210%. So now we have got yield of comparable traded, frequently traded bonds. What we are going to do, we are going to calculate linearly interpolated yield for a 4-year bond. Again the same y2 minus y1 upon x2 minus x1, or step 1. What was the step 1 in theory? We were having step 1 as step 1 identify, calculate YTM. We have identified, calculated YTM. So this is actually step number 3 as per theory. So what is the, this is your step 1, this is your step 2, and now we are going for step number 3, the linearly interpolated YTM. So we have bond P, we have bond Q, we have bond P of how many years? 3 years, 6 years, yield is 7.0916, 7.9210. We have bond P and R, not Q, P and R, and we want to value a bond Q which is of 4 years. Now what is the yield? So yield will be equals to, desired yield for Q will be equals to 7.0916 plus 7.9210 minus 7.0916 over 6 minus 3 whole multiplied by 4 minus 3. So value is equals to 7.9210 minus 7.0916 divided by 3 multiplied by 1, that is same number. So it is giving us 7.0916 plus 0.2765, which is equals to plus 7.0916 equals to 7.3681%. So for bond Q, we have a desired yield from linearly interpolated yields of comparable actively traded bond is equals to 7.3681. So next, step number 4, the valuation of Q, fundamental valuation of bond Q. So bond Q, we have N equals to 4 years. Yes, 4 years. Coupon is 10%, 1000 face value. So face value 1000, PMT is 100, and IY is 7.3681. Compute PV, we have, this is 3681. We will put IY 4 as my N, 1000 as my FV, and 100 as my PMT. So I got a PV of 1088.41. So this is the fundamental price from the desired yield calculated from matrix pricing method of using the yields, implied yields of YTM of actively traded bonds in the market. So I hope everyone understood this. 2 type of questions we have done. So please do practice from study mat, and thank you so much.